In our last two videos, we covered two key moments. First, Iran's proposal being routed through Pakistan, and second, Trump saying he's not happy with that proposal. Now here's what happened after that, and why the situation has actually become more complicated, more dangerous for markets, and more important for India than most people realize. Welcome back to Yearn to Grow. This channel is about understanding finance and insurance clearly and calmly. No pressure, no shortcuts, just clarity. The clearest proof is that the negotiations stayed stuck on the same structural issue. Iran wanted a sequence where Hormuz, shipping, and blockade relief comes first, and the nuclear track comes later. While the US kept the line that a durable end depends on a deal that prevents Iran from getting nuclear weapons. Reuters later reported a senior Iranian official saying Trump rejected a proposal that would reopen the Strait of Hormuz before nuclear talks, and Trump's line remained that the terms were unacceptable. Then the proposal talks evolved into something more explicit. Iran sent what was described as a 14-point plan via Pakistan, and Trump said he was reviewing it, while also saying he can't imagine it would be acceptable and warning strikes could restart if they misbehave. That's crucial because it tells markets the US is signaling, I prefer a non-military route, but also military options remain. Reuters described this 14-point plan, including things like troop withdrawals, sanctions relief, unfreezing assets, and guarantees against future attacks, with the US still skeptical. At the same time, you saw escalation signaling from Iran harden too. Multiple reports quoted Iranian officials warning that renewed war is likely if talks fail, meaning the ceasefire is not being treated as a stable endpoint, but more like a pause while both sides keep leverage. Now here's the most important new layer after the proposal drama. The battlefield moved into Hormuz payments, sanctions risk, and shipping compliance. The US Treasury, OFAC, issued warnings that paying Iran for safe passage, described in coverage as tolls, fees for transiting the Strait of Hormuz, could expose shippers and intermediaries to sanctions. And this risk applies even if payments are disguised through barter, digital assets, offsets, in-kind contributions, or even charitable donations. That's how you build financial stability. That changes the game because reopening Hormuz becomes more than a political statement. It becomes a legal, financial problem for insurers, banks, ship owners, and cargo buyers. If companies can't confidently insure or settle payments without sanctions exposure, then even limited transit doesn't equal normal trade. And while this is happening, the US narrative also shifted inside Washington because of the war powers clock. Reuters reported that the Trump administration argued the ceasefire had terminated hostilities for war powers purposes as the deadline approached. Even as critics dispute whether the conflict is truly over when blockades and deployments continue. That matters because markets read it as the administration is trying to frame the conflict as ended legally while keeping the ability to continue pressure and keep options open. Now let's talk about the oil market properly, because oil is the most direct truth meter for this war. You saw crude spike hard as the Hormuz disruption story stayed unresolved. Reuters reported oil hitting a 4-year high above $125, with Brent referenced around 126.41 nulls intraday before pulling back. And the broader coverage has consistently emphasized that Hormuz disruption affects a major share of global oil and gas flows. The reason oil is holding up is not one headline, it's structure. The market is pricing a world where the strait isn't back to normal, where enforcement and restrictions can tighten suddenly, and where even safe passage could be costly, selective, and legally complicated due to sanctions warnings. That combination keeps what traders call the risk premium embedded in price. So where are the current levels and what do they imply? Right now, the key market context is that crude has traded in a high volatility zone after printing those 4-year highs. And the market has been reacting to two competing forces. One, a belief that disruption could persist, and two, a belief that global producers and policy tools might cushion the shock. One of the biggest cushioning narratives comes from OPEC+. Reuters reported OPEC Plus was set to approve another symbolic output quota increase for June, 188,000 BPD. even with Hormuz closed. Symbolic because actual supply increases may not translate into real barrels if Gulf exports are constrained by the crisis. That means the market can hear output hike, but still price scarcity because the problem isn't only production, it's flow. This is why oil is difficult right now. It can drop sharply on any credible de-risking headline, but it can also spike violently on any incident. Oil's bullish triggers are straightforward. Any report of new shipping attacks, seizures, mine threats, tighter blockade enforcement, or a collapse of diplomacy instantly reprices the tail risk. Oil's bearish triggers require something much harder. Not talks continue, but practical normalization, sustained transit, insurers returning, and freight rates stabilizing. Without that, even if the ceasefire holds, oil can remain supported because traders treat it as a fragile pause where the next shock is always possible. Now gold. This is where your viewers need a better explanation than the usual war, fork, gold up. Gold is being pulled by two engines at the same time: fear demand and rate hot inflation pressure. Reuters reported gold falling to a one-month low around 4,528 IEs after the Fed kept rates unchanged, with traders worried about inflation stemming from the Middle East war. That tells you the second engine. When oil rises, inflation expectations rise. And that can keep yields and the dollar supported. Both are headwinds for gold, even in a geopolitical crisis. At the same time, markets were explicitly waiting on Powell's comments to understand how the Fed views the war's inflation and growth impacts. Reuters' coverage captured that waiting for Powell dynamic, and Powell has also previously framed the Fed as able to wait and see how the war affects inflation, typically trying to look through shock effects but acknowledging uncertainty. Gold is not just reacting to missiles, it's reacting to what oil does to inflation and what inflation does to Fed expectations. If the market mood is war risk is contained but energy costs stay high, then gold can struggle because the inflation rates channel dominates. If the mood flips into this is escalating and risk assets are threatened, then gold can rally aggressively because fear overrides yields temporarily. That's why gold can look weak on a day where the news sounds scary and then explode higher in minutes on a true shock headline. Now bring Powell into the center of the story properly, because Powell is the hinge between war headlines and market pricing. When Powell signals we can wait and see, markets hear rates stay higher for longer, especially if inflation risk from oil is persistent. When Powell signals growth risk is rising and we may need to support demand, markets hear rate cuts sooner, which can weaken the dollar and lift gold. Reuters explicitly framed Powell's posture as waiting to see how war affects inflation and economy. The clean takeaway: Powell decides whether the shock becomes a long inflation cycle or a short spike. Now we go to the India impact, because India feels this war faster than most regions. India is a major crude importer, so when Brent shoots above $110 and then spikes above $125, that's not just a chart, it's a macro tax on inflation, the rupee, and corporate margins. Reuters linked reporting showed India having to publicly urge people not to panic buy fuel and saying there was no proposal to raise pump prices for petrol and diesel at that time. But the pressure still leaks into the system. Reuters reported Indian oil hiking industrial LPG prices sharply and raising jet fuel prices for foreign airlines. That's a real-world signal of war cost. Then you see it in INR and equities. Reuters reported the rupee closing at record lows amid rising oil prices and foreign selling pressure. Additional Reuters reporting described persistent bias toward rupee weakness because oil is high and capital flows are weak. On the stock market side, Reuters reported Indian shares opening lower and staying pressured as oil surged because higher crude raises inflation risk and caps earnings optimism. So how do you explain India's market mechanics? Like this: when oil rises, India's import bill rises, the trade deficit pressure grows, and the RBI's room to be dovish shrinks. That tends to support USD-INR upward bias. For equities, high oil is generally a headwind for airlines, logistics, chemicals, and consumer companies. It can also pressure banks indirectly if inflation risk keeps policy tight and slows growth. You don't need to scare people, you just explain the chain reaction. Now, to list all the updates after Trump not happy, the US remained unhappy because the proposal sequencing didn't satisfy Washington. Iran then escalated the proposal into a longer plan, 14 points via Pakistan. Trump said he's reviewing but skeptical. Iran signaled renewed war is likely if talks fail. The US then added a major sanctions compliance layer, warning shippers against paying Hormuz tolls. Washington shifted into war powers framing by claiming hostilities are terminated under the ceasefire. US reinforced regional posture by fast-tracking over 8.6 billion in arms sales, and in parallel, the market reaction proved the crisis wasn't solved. Oil spiked to 4-year highs, OPEC Plus talked symbolic increases, gold fell due to Fed policy uncertainty, and India started feeling it through INR pressure. The ceasefire may pause direct fighting, but the war is still running through shipping control, sanctions, and political risk. Oil is pricing disruption first, gold is pricing the inflation versus fear battle. Powell decides whether the shock becomes sticky inflation, and India is exposed. The biggest mistake traders make is thinking no new missile headlines means calm, because with Hormuz and sanctions, you can get a shock without a single bomb. And you can also get a sudden de-risking headline that causes a violent unwind. In this kind of market, structural clarity is your only defense. If this explanation helped you see things a little more clearly, that is exactly what this channel is meant for. We will continue breaking down finance and insurance concepts step by step in a way that feels practical and manageable. If you find this helpful, please like the video, subscribe to the channel, turn on notifications so you do not miss future videos.